Nvidia's NVDA 0.98% stock has surged by an astonishing 26,000% over the past 10 years. From fiscal 2014 to fiscal 2024, which concluded in January, the company's revenue grew at a compound annual growth rate (CAGR) of 31%, while its earnings per share (EPS) increased at an even more impressive CAGR of 50%. This remarkable growth was fueled by the rapid expansion of Nvidia's data center business, which supplies high-end graphics processing units (GPUs) for machine learning and artificial intelligence AI tasks, along with steady sales of gaming GPUs that also found use in cryptocurrency mining. Additionally, Nvidia has been expanding its automotive chip business and ramping up shipments of its Tegra system-on-chips (SoCs) for various devices. Despite these stunning market-beating gains, one notable investor who missed out on this historic rally is Warren Buffett. The Oracle of Omaha didn't purchase a single share of Nvidia for Berkshire Hathaway, BRKA-0.43%, BRKB-0.39%. Let's explore why Buffett continues to steer clear of one of the market's most sought-after tech stocks. Nvidia aligns with some of Buffett's investment criteria. Nvidia meets several of Buffett's well-known criteria for choosing stocks. Buffett favors companies with wide moats, and Nvidia is undeniably the dominant force in the discrete GPU market. As of the first quarter of 2024, Nvidia held 88% of the desktop GPU market. According to JPR, and TechInsights estimates it currently controls about 98% of the data center GPU market. Buffett also prefers companies with a gross margin exceeding 40%, signaling strong pricing power and competitive advantages. Nvidia's gross margin grew from 59.2% in fiscal 2023 to 73.8% in fiscal 2024, with an additional 13.8 percentage points increase year over year to 78.4% in the first quarter of fiscal 2025. This rapid growth was driven by Nvidia's unmatched pricing power in the data center GPU market as more companies upgraded their servers to accommodate AI applications. Another of Buffett's benchmarks is that a company should spend less than 30% of its gross profits on research and development (R&D), indicating that it isn't overly reliant on investing in new projects to maintain its competitive edge. Nvidia spent just 20% of its gross profit on R&D in fiscal 2024, and that ratio fell to 13% in the first quarter of fiscal 2025. Additionally, Buffett prefers companies that spend less than 30% of their gross profits on sales, general, and administrative SG&A expenses, as firms with established moats typically don't need to spend excessively to attract new customers. Nvidia's ratio was a mere 6% in fiscal 2024 and 4% in the first quarter of fiscal 2025. Finally, Buffett seeks companies that can sustain a net profit margin of at least 20%. Nvidia reported a net margin of 49% in fiscal 2024 and 57% in the first quarter of fiscal 2025, so why hasn't Buffett invested in Nvidia? Despite Nvidia's strong appeal to many investors, Buffett has famously avoided tech stocks for much of his investing career, preferring businesses that offer predictable long-term returns. Moreover, Buffett once advised investors to never invest in a business you cannot understand, and Nvidia's complex chip-making business can be challenging to fully grasp without a technical background. While Buffett has increased his exposure to tech stocks over the past decade, his investments have primarily been in established blue-chip companies like IBM, Oracle, HP, and Apple. The cloud data warehousing firm Snowflake was one of the few high-growth tech companies in his portfolio. Interestingly, Buffett has been reducing his tech sector exposure in recent years. He sold all of his IBM shares in 2017, exited Oracle in 2019, and recently divested his holdings in HP and Snowflake. He even trimmed Berkshire's significant stake in Apple. Instead of chasing high-growth tech stocks, Buffett has been accumulating cash and short-term treasuries, with Berkshire ending its latest quarter with a record $177 billion in cash and equivalents. This suggests that Buffett is preparing for potential buying opportunities in the event of a market downturn. His cautious approach is not surprising, given that the S&P 500 is near its all-time highs and appears expensive at 21 times forward earnings. Buying Nvidia stock doesn't align with that strategy. Nvidia's shares are trading at 47 times forward earnings and 25 times this year's sales, and with Wall Street's sky-high expectations for the expanding AI market, any signs of a slowdown could significantly impact Nvidia's valuation. These factors don't match the stable and predictable returns that Berkshire Hathaway typically seeks. Should you follow Warren Buffett's example? Buffett clearly prefers predictable, cash-rich companies in sectors like insurance, banking, railroads, utilities, and consumer staples. If you lean toward that conservative investment strategy, you might consider avoiding Nvidia. However, if you believe the emerging AI market has substantial growth potential in the coming decades, it could still be worthwhile to have some exposure to this red-hot stock, even if it doesn't fit Buffett's criteria for a reliable long-term investment.